Right, and on to monetary policy. This is a bit of a theme this week. Kenya Central Bank held its benchmark lending rate at its exact previous level, 11.5%, with the committee noting that the exchange rate had stabilized and the current account deficit had narrowed as well. Remember, it had raised the lending rate by about 300 basis points earlier in the year, in part to support a rapidly weakening shilling at the time. Now, the currency had plunged by almost 18% to the dollar following the global strengthening of the greenback and a slowdown in revenues from key sectors like tourism, for example. The bank's Monetary Policy Committee specifically stated that lower oil prices and a slowdown in consumer demand and therefore imports had helped to narrow the current account deficit. Let's dig into the nitty-gritty details of that particular statement. Bidamwema from African Alliance is with us in studio right now. Thank you so much for your time this evening. Let's start with your broad impressions of the MPC statement today. What do you make of the decisions therein?
I think it was a good decision that the MPC made, leaving the rate as it was before. But you have to remember that they've been using other open market operations to manage liquidity in the market in the form of repos and reverse repos. And they mentioned in the statement that the application of the reverse repos had been very successful for them, therefore also going to the extent of warranting a non-movement of the central bank rate at today's MPC meeting.
Indeed, but if the CBK, of course, is keen on keeping lending rates low, and have seen messages to that effect over the last couple of weeks, that inevitably means that at some point we'll have to take a hit once the Fed starts to normalize policy. Has that already been priced into the dollar shilling rate, or do we have much further to fall come December?
I would say it's 50-50. There'll be increased depreciation on the currency between now and maybe the next 6 months. You have to remember that as the Fed hikes its rate, there'll be an outflow of capital that had been allocated to Kenya in the form of FDI, and that will be negative for the country. So as there's that pullback of currency inflows into the country, that will be certainly very negative for us and will cause a further weakening. I think from the current levels, maybe there'll probably be another 5 to 10% weakening, and we think we'll probably settle at 107, 110 on the worst case.
Right. There's been a lot of talk about an income shock coming into the economy, partly as a result of government's very erratic expenditure so far in this fiscal year. What companies on the bourse are most exposed, most at risk to that income shock?
I think I'll divert before I answer that directly. You mentioned the current account deficit coming down, but you also have to recall that there's the element of the fiscal deficit. The fiscal deficit being what the government is spending at a national and at a county level, and that's been on the increase. What this means is the government will be coming back to seek additional funding from the already illiquid market, as it were, and that will push up interest rates. When interest rates go up, the effect on the consumer is not able to consume as much as they were consuming a year ago, and it becomes even harder to be able to run your businesses if you're getting your lending at 25%. What does this mean for companies on the stock exchange? You'll have your defensive plays, companies that are accumulating prepaid assets in the form of telephone bills like Safaricom or KPLC in terms of electricity bills. It will be positive for them. But for other companies that have been very dependent on foreign currency lending, the likes of Kenya Airways, will not be in a good place, especially as the currency devalues. Athi River Mining is also another company that will probably be in that slot. It has had a lot of foreign currency lending, and a lot of its book is actually exposed to high interest rates, making it a hard environment for it to operate for the next year.
And that segues neatly right into my next question. We've got over $6 billion worth of domestic debt maturing next year in a matter of months, so to speak. What are Treasury's options in navigating through that enormous refinancing risk?
Again, I'll go back to the open market operations. I think the central bank has been very effective in using this instrument. When the liquidity is very tight, they will issue reverse repos to inject liquidity into the market. When the liquidity is too much, they'll actually be in the market in the form of repos. I think that will be the key thing that they'll probably be pushing in terms of mobilizing liquidity. And then second, to also recall that when interest rates went up, the subscription levels for the T-bills and for the T-bonds were at very high levels. So I think what the government will seek to do prior to the repayment of this maturing bonds will be to accumulate as much liquidity from the market, if nothing else, to be able to meet that payment. Overall, that will have a negative impact on interest rates. I think in as much as they've come down, we'll expect a slight hike over the next 6 months or so as we anticipate this payback. Right.
One final question for you, Mbide.
Yes.
Is the argument for looking for an IMF bailout a lot stronger now? And if it is, when do you expect the Treasury and the central bank to go cap in hand over to Washington to ask for a bit of money?
We actually have a lot of money from the IMF, we just haven't tapped into it. I think the IMF issued a note in September in as far as the assessment of Kenya was. Key things from this note were the fact that our debt sustainability levels are okay, and more importantly, even though the Treasury decides to draw down into its SDR facility with the IMF, the repayment will still be sustainable. So I think we have the facilities at hand. It's just managing and deciding at what point you decide to draw down before you have to renegotiate another SDR from the IMF.
All right, we'll leave it there for the time being. Thank you for your time. That's Mbida Mama from African Alliance walking us through the latest statement from the MPC.